This is Will McCauley. I'm here with Mike Reed. We're going to review this week's proprietary research and analysis piece on crude and natural gas production in the United States. The topic this week is the Red Queen hypothesis. This is actually a hypothesis that is based and used in evolution. It really comes from a Lewis Carroll character, the Red Queen, who had to run faster and faster to stay in the same place. If she slowed down, she would actually go backwards. The Red Queen, by the way, not to be confused with the Queen of Hearts. Mike is going to walk us through how this hypothesis is currently playing out in the United States crude and natural gas production. Mike.
The hypothesis is really based on the rate of change of two things. One is, what's the rate of change on productivity per rig against what's the rate of change in depletion? And so the argument is the productivity per rig is actually slowed while depletion is actually accelerated. So we're going to go backwards on production in the event of rig count plateauing. I think it's interesting when we look at the U.S. rig count, whether it's natural gas or crude rig counts really plateaued about 17 weeks ago, and we've been flatlining. Natural gas rigs actually plateaued about 9 weeks, and we've been flatlining. Our view is this is a leading indicator that production is going to roll over sharply to the downside on both crude and natural gas. What we're going to walk you through now is two views of how to think about production and productivity. The first view is production per rig initial, which is a very common approach to use. And then we're going to show you an unconventional way to think about it. We're going to call it production per rig total. If we look on the oil side of the equation, the left side graph is the conventional chart that we see. This is EIA data showing the day one production from an oil rig against the prospective basins. If I average those basins, just take a straight line average for now, I get an increase of about 8% productivity improvement year on year. And so the market's looking at this, they're kind of appeased by it, saying, yeah, it's still moving up, all is good. The chart on the right gives you a much more ominous picture about what's going on. And what we're doing is we're just taking total current production of oil in the U.S. We're dividing it by rig count 2 months ago because of the lag between rig and production. You could argue it should have been 1 month ago or 3 months ago, but I think 2 months is a good median point to use. It tells a completely different story. It tells us that productivity really peaked out about 2 years ago, and we entered the Red Queen scenario and have been in it for about 2 years. If you look at the extreme right of the crude chart, you can see it's actually started to roll over in 2018 and is trending down. So we think that this is going to accelerate on production decreases in the event of a plateaued rig count. So what I want to do now is demonstrate the same graphs, turn it back over to Will. Let's look at the natural gas side.
Great. Yeah, thank you, Mike. Again, we have two charts. Like we showed on the previous slide, these are just associated with natural gas production in the U.S. rather than crude oil. Natural gas side, at least on the initial day one production, is actually a little bit better than crude. It's up about 14 to 15%, again, straight line across all of the basins in the United States. However, when you look at the total production versus lagged rig counts, you see a similar picture to what you saw on the crude side. Again, the peak happened, call it late 2016 or even early 2017, and we've had a relatively flat period for 2017 and 2018. Now, if you zoom in on 2018, you can see that similar to crude, it's starting to roll over a little bit. It's not as dramatic as crude, but you're starting to see the same picture take hold in the gas market and production that you did see in the crude market.
Now let's take a look at the value chain on the crude side of the equation. What we've done here is when we were peaking in July 2016, U.S. crude production is about 8.5 million barrels a day. Today, it's 11 million barrels a day, so our production's gone up about 2.5 million barrels a day. On the rig count, 2 years ago, rig count was 318. Today, it's 863, so you've had a jump of 545 rigs. Now, when you look at this from a variance perspective, what it tells you is you've increased your production about 29%, but it took a whopping 171% increase in rig count to do it. And I know it's a little bit startling, but before we continue on, let's go to the next chart. We know that during the last several years we've drilled quite a few drilled uncompleted wells or DUC wells. So we have to adjust for the DUC wells. 2 years ago we had 3,928 DUC wells in the oil basins, and today we have about 6,400. So we've had an increase of about 2,400 DUC wells. When we look at those DUC wells and assume 60 days average between drilling and production, we can assume 186 rigs were really allocated to drilling non-production wells or DUC wells. So what we've done in this value chain is we've reduced the rig count by 186, dropping it to current 677 so that we can compare apples and apples. And when we do that, we get a different answer. It's still ominous. We get a different answer. It tells us production's unchanged in the sense of, yes, it's increased 29% during this time frame, but the rig count still increased 113%. So net our efficiency has actually dropped 39% since the peak 2 years ago in 2016. Let's do the same value chain with natural gas, but we're going to introduce one more complexity, and that is we're going to adjust for associated gas. Will?
Perfect. Thank you, Mike. Yes, so a similar table as what we saw previously on the crude markets. This is for natural gas. So you can see between 2016 and 2018, production increased about 9.6 BCF. However, during that period, you had 111 rig increase over that time frame. So again, for a 13% production increase, it required 135% increase in rig counts. Now that leads to a efficiency decline of 52%. So you're actually even worse than the crude markets. Now we have two adjustments to make, which we'll go through on the next slides, but it actually ultimately gets a little bit worse, not better like the crude market. So the first one we're going to look at is DUC wells, again, the drilled uncompleted wells. You've actually seen a decline in natural gas only DUC wells over that period, so that's down about 62 wells over the period. So that means actually 6 rigs that were previously allocated to DUC well production, or drilling, excuse me, have been reallocated to natural gas production. So our rig count is actually up even more than it was previously. So with that new adjusted rig count, our efficiency is down 53% over this period. Then the final thing we have to do is look at associated gas production, that is, again, gas production from crude oil wells and crude plays. So if you look at that over this period, associated gas production has increased significantly from 1 BCF a week to 58 BCF a week. That change is about 8 BCF per day over that period. So if you actually reduce production by that 8 BCF, you end up with actually only a total production increase adjusted for associated gas of 1.5 BCF increase over this period. You still have the same rig count growth of 143%, so that makes our variance and change in efficiency look even worse for natural gas. It's down 58% after considering those two adjustments. So again, if we are in a situation where production or rig counts have plateaued, we should see a very steep and rapid decline in natural gas production. So again, just to summarize, my comment applies for the crude market as well. In both cases, we have seen plateaus in rig counts for crude and for natural gas. Expect significant declines in production if rig counts stay flat as they have been over the past number of weeks. The other flip side to this is actually bullish view on oil field services. As you have decreased production and price increases, that should increase your demand for oil field and associated services. For a full research report and all of the detail that went into this analysis, please visit us at cEntellect.com.